Imagine agreeing to pay off a car until the next decade for a vehicle you might not even own by them.
Yeah, that's a terrifying thought.
It really is. And the crazy thing is, over 40% of buyers who are rolling negative equity into a new car are relying on 84-month loans just to make the monthly payment math work.
Right, just to scrape by.
Exactly.
Yeah.
Welcome to Auto News Talk. If you are walking into a dealership expecting to, seamlessly trade in your old car and negotiate a great price on a new midsize SUV, you are basically stepping onto a battlefield.
Oh, absolutely. It's a completely different landscape now.
So we are going to unpack exactly why buying a car feels mathematically impossible for a lot of people. Because despite all the industry claims of market stabilization, the people making the cars, the dealers selling them, and you, the consumer trying to buy them, are caught in this intense, simultaneous financial squeeze.
Right. And this isn't just about the sticker price on a window.
No, not at all.
This is a massive, fundamental breakdown in how vehicles are priced, built, and sold. And to really understand this tension, we kind of have to map out the terrain by tracing a vehicle's journey backward.
Okay, I like that approach. Where do we start?
We are going to start at the global supply chain, walk through the upstream manufacturing shocks, and then look at how those massive hidden costs crash directly into your wallet at the finance desk.
Right, the fun part.
Yeah, exactly. And finally, we'll explore how this pressure cooker is fundamentally breaking the physical dealership experience. Because this is a connected ecosystem.
Right, one piece affects the other.
Exactly.
Right.
And the incentives at every single level are totally out of alignment.
So let's start at the very beginning of the pipeline, long before a car ever hits the showroom floor. I was looking at this research focused on auto tariff shifts and how they reshape supply chains. And it provides this incredible look at how global trade policy is just injecting massive, unavoidable costs into the system.
Yeah, the central insight from that research is that trade actions and shifting legal authority they're fundamentally altering vehicle costs on a global scale.
So it's not just a minor supply hiccup.
No, not at all. The analysis outlines a tiered system that maintains a staggering 50% tariff on raw steel and aluminum.
50%, that is huge.
It is. And most derivative goods fall to a 25% tariff. On top of that, a 10% global tariff under the 1974 Trade Act was introduced.
Wow.
So there are layers upon layers of cost accumulating before a single piece of metal is even stamped into a car door.
And it is not just a straightforward policy rollout that automakers can easily plan for, right? Because that same supply chain research notes that the Supreme Court actually ruled to narrow executive authority over sweeping tariffs,
Right.
which invalidates certain broad levies and forces a pivot in the legal strategies used to enforce these trade laws. So, how does a manufacturer deal with billions in added industry costs without completely scaring off the buyer?
Well, they get creative with how they present the bill.
Ah, of course.
Automakers are trying desperately to hold baseline prices steady where possible, while transitioning their supply chains. But those costs, they have to go somewhere.
Right. They don't just disappear.
Exactly. And the report highlights a pretty staggering statistic. Automakers are passing these massive costs along through record-breaking destination fees.
Oh, the destination fees.
Yeah. For example, there is a $2,795 fee tacked onto full-size GM and Ford trucks and SUVs.
$2,795 just in destination fees.
Just to get the car to the lot.
To put that in perspective, putting tariff costs into a destination fee is exactly like a restaurant keeping a burger priced at $10 on the menu, but charging a mandatory $4 kitchen operations fee on the final receipt.
That's a perfect analogy.
Right. It protects the marketing illusion of an affordable product. The manufacturer gets to advertise a lower MSRP, but then they ambush you with a non-negotiable line item at the very end.
Yeah, and the researchers estimating this impact actually cite AlixPartners, who project that automakers will likely pass about 80% of these tariff costs directly to buyers.
80%? Wow.
Yeah, and the implication of that is massive. It's projected to cut vehicle sales by about 1 million units over a multi-year horizon.
Because people just get priced out.
Exactly. It fundamentally shrinks the market. However, what this particular analysis leaves unanswered is whether upcoming international trade reviews, specifically the scheduled review of the USMCA, will actually ease these pricing pressures, or if they will trigger new disputes that make those raw material costs even worse.
Right, which brings us right to the showroom doors where that flood of hidden upstream costs is just drowning the average buyer.
Oh, absolutely.
So how does this actually show up when a buyer sits down at the finance desk? There is this operational analysis where dealer leaders sound the alarm on profit pressures, and it zooms right in on the consumer affordability breaking point.
Yeah, that report is eye-opening.
It really is. The central insight there is that there is an acute rising strain at the retail level that is just tearing the traditional consumer buying model apart.
And the physical manifestation of this is a completely bifurcated buy-sell market for the dealerships themselves.
Okay, what does that mean exactly?
Well, premium stores in high-growth states like Texas and Florida, they still command high multiples, meaning they can be sold for many times their annual earnings because wealthy buyers can still absorb the price hikes.
Right, the luxury market is insulated.
Exactly.
Right.
But mainline stores selling everyday commuter cars in crowded markets, they are actively struggling, or breaking, as the industry calls it.
Breaking, that's a heavy word to use for a business.
Yeah, and when you look at the mechanics of why those mainline stores are breaking, the consumer numbers are terrifying.
Well, that operational analysis points out a massive affordability crunch driven by a surge in negative equity.
Right.
And let's explain what that means for a second. Negative equity is when you owe more on your car loan than the car is actually worth.
Being underwater.
Exactly. So if you owe $20,000, but the dealer can only give you $15,000 for a trade-in, you have $5,000 of negative equity. And here's the jaw-dropping stat from that source. Over 40% of negative equity deals rely on 84-month loans just to make the monthly math work.
40%. I mean, think about the financial trap of that mechanism for a moment.
It's wild.
Stretching a car loan out to 7 years just to absorb the debt from a previous vehicle, it creates a vicious compounding cycle. You're paying interest on the debt of a car you do not even own anymore, wrapped inside a loan for a new car that is actively depreciating.
Consumers are entirely trapped.
Totally. And the implication here is that these buyers will remain in a state of negative equity for years to come, which directly eliminates them from the market.
Right, because the dealer simply cannot sell them another vehicle 3 or 4 years down the line.
No, the math is just too upside down. It creates a massive class of what we could call zombie buyers.
Zombie buyers. That's a great term for it. And furthermore, that same report highlights how overlapping desperate strategies from the automakers, the OEMs, and the dealers are creating this really adversarial customer experience.
Oh yeah, the surveys.
Yes. A buyer finally gets through a grueling, stressful 84-month financing process, and then they are bombarded with disjointed satisfaction surveys from both the dealer and the factory. And both sides are basically trying to assign blame for the miserable experience.
Right. It points to a massive structural flaw. And it raises an important question that the operational analysis actually leaves open, which is exactly how do manufacturers intend to fix universally disliked stair-step incentive programs?
Oh man, the stair steps. We should definitely clarify what those are for the listener.
Yeah, go ahead.
So a stair step incentive is basically an all-or-nothing video game quest for a car dealer.
That's a good way to put it.
The automaker tells a dealer, if you sell 99 cars this month, you get your standard profit. But if you hit exactly 100 cars, we will retroactively give you a massive cash bonus for every single car you sold.
Right, which forces dealers to do crazy things at the end of the month.
Exactly, like taking massive losses on a single vehicle just to hit that arbitrary factory target.
Yeah.
The industry is deeply divided on whether they need to demand systemic reform of these chaotic, volume-based bonus programs, or if dealers should simply opt out and avoid the brands that utilize them altogether.
The pressure on the dealership model from these factory demands is just immense. And this is heavily reinforced by insights from an industry podcast panel warning of mounting dealer pressure from OEM strategies and FTC scrutiny.
Right. That panel really laid it out.
They did. The central insight there is that the entire auto retail landscape absolutely requires transparency and coordination to stabilize because the current environment is completely unsustainable.
The panel emphasizes that lingering supply distortions mean the low inventory and high pricing power we saw in previous cycles simply have not normalized.
Right.
And those knock-on effects are hitting everything from dealership staffing levels to local marketing budgets. The operators who will prove most resilient are the ones emphasizing highly disciplined production, while automakers desperately need to refocus on attainable price points.
But the vice grip is tightening. Here is a specific squeeze highlighted by that podcast panel. Used vehicle values are rapidly cooling down while consumer credit conditions continue to tighten up.
Which is a terrible combination.
It's the worst, because that dramatically reduces a dealer's ability to offer you a good trade-in value, which in turn reduces their ability to absorb the misaligned, overpriced products the manufacturer is basically forcing them to take.
Right. Let's break down the mechanical reality of that vice grip, because this introduces another crucial piece of industry jargon, which is floor plan costs.
Ah, yes. The invisible killer.
Exactly,
Uh-huh.
because a dealer doesn't own the cars on their lot free and clear. They buy them from the factory using high-interest commercial credit lines. That's the floor plan financing.
Right.
So every single day a car sits unsold, the dealer pays interest on it.
Yep.
So if used car values are dropping but credit is tightening, the dealer can't offer buyers enough money to make a trade-in work. So the new car doesn't sell, it sits on the lot, and that floor plan interest just ticks up day after day.
Exactly. The implication is that dealers are carrying massive capital risk. They have millions of dollars tied up in slow-turning vehicles, which directly threatens the financial viability of those mainline stores we talked about earlier.
But what the podcast panel report doesn't detail is the physical constraint behind this problem. I mean, how quickly can massive global automakers actually recalibrate their production lines to match these highly localized affordability bands?
That's the million-dollar question.
Right. You can't just flip a switch and turn a luxury SUV factory into an economy car plant overnight. The lead times are massive.
And this leads us directly to the fundamental showroom disconnect. There is enormous friction between what manufacturers want to build for maximum profit and what dealers are actually able to move off the lot given the reality of your wallet.
It's a total mismatch.
To explore this, we have a deep look into dealer pressure points involving compliance risk and OEM conflict. And the central insight of that piece is that operational friction is pushing dealers to loudly demand tighter collaboration on product design and much clearer regulatory guidance.
Right. And the report notes a fascinating contradiction. Average transaction prices have barely moved downward despite the widespread affordability crisis.
Because the automakers they're stubbornly producing for a high-margin environment that no longer exists for the average consumer.
Exactly.
The dealer pressure points analysis points out that operators who can add true operational value might actually find lucrative opportunities in acquiring those struggling, breaking stores we mentioned and fixing their operations.
Sort of a buy low, fix it up strategy.
Right. It also notes that the cumulative causes of this affordability crisis include a pullback in affordable leasing options, which stacked directly on top of elevated vehicle prices.
There's a fantastic quote in that source from panelist Matt Bowers that perfectly encapsulates this. He notes that dealers are stuck carrying the massive floor plan cost of overpriced, overfeatured, screen-heavy vehicles.
Overfeatured is exactly the right word.
It really is. These are cars heavily influenced by international demand signals rather than what the average U.S. buyer actually wants, or more importantly, what they can afford.
Which forces dealers into a corner.
Yeah.
They have to evaluate these underloved stores and completely overhaul their advertising and operational strategies just to survive the market squeeze.
The implication being a total restructuring of the retail landscape.
Absolutely. Additionally, this source highlights another layer of pressure. Dealers are being urgently pushed to standardize their finance and insurance disclosures following direct warnings from the Federal Trade Commission regarding hidden fees.
The FTC is heavily scrutinizing the very add-ons and hidden fees dealers use to make a profit on those overfeatured cars.
Right, because the margins on the cars themselves are so weird right now.
But a clear limitation of the dealer pressure points analysis is that it leaves unanswered exactly what the FTC's follow-through will look like. I mean, they sent warning letters to 97 dealer groups without issuing any initial fines.
So everyone's just waiting.
Exactly. The whole industry is holding its breath, wondering, is it just a bark or is a massive regulatory bite coming?
And that looming regulatory shadow brings us to a comprehensive survey where dealer leaders warn of an intensifying profit squeeze as OEM policies and FTC scrutiny collide.
The perfect storm.
Truly. The central insight here is that the aggressive push toward direct-to-consumer sales, combined with these misaligned inventory mixes, is fundamentally threatening the traditional franchise model.
The report makes it clear. Total vehicle supply isn't the only issue. The inventory mix has to match actual consumer demand.
Yeah.
Panelists in the report praised Toyota specifically for maintaining highly disciplined inventory management. You know, building cars people actually want at prices they can reach.
Which shouldn't be a novel concept, but here we are.
Right. But at the same time, you have other automakers exploring direct sales models, like the new Scout brand, which bypasses the dealer entirely. And this threatens the massive physical investments local dealers have made in their communities.
The direct sales model is the ultimate flashpoint. If we look at the data cited in the piece from a CDG Circles survey, an overwhelming 97% of dealers view those chaotic stair-step incentive programs unfavorably.
97%. That is pretty much unanimous.
It is. It shows a massive disconnect between factory goals and retail realities. But here's the real aha moment regarding the direct-to-consumer shift. Removing the dealer from the equation eliminates what dealers call the accountability layer.
Right, because right now dealers act as a massive financial shock absorber for the automakers. If the factory builds ugly, overpriced cars, the dealer is forced to buy them anyway, taking on all that high-interest floor plan risk. If the automaker goes direct to consumer, they suddenly have to hold all that inventory risk themselves.
And the dealers argue that without local franchises aggressively competing against each other to clear out cars, consumers could ultimately be hurt by less competitive pricing and significantly weaker service infrastructure.
Right. It completely alters the pricing structure of the auto industry.
Absolutely.
Though I do have to push back just a bit on the industry's absolute certainty that direct sales will fail.
Okay, let's hear it.
Well, the survey source relies heavily on a panelist's claim that Tesla's roughly 5% market share proves the direct-to-consumer model has limited mainstream appeal.
Ah, I see what you mean.
Yeah, what this source leaves as an open question is whether mainstream consumers will actually reject the direct sales model long term. I mean, using a 5% market share as definitive proof feels like wishful thinking on the part of dealers. That claim remains to be fully tested by the broader market.
That is a very valid critique. The market preferences are shifting rapidly, and assuming the old rules apply it's dangerous.
So true. Okay, let's step back and look at the whole board here. When we synthesize all the moving parts across these analyses, three massive themes emerge.
Let's run through them.
First, the affordability crisis. This is heavily supported by the findings in the operational analysis of dealer leaders sounding the alarm and that podcast panel warning piece. We can see exactly how upstream raw material tariffs and desperate 84-month loans are fundamentally breaking the consumer's wallet and creating zombie buyers.
Yes, and the second theme is product misalignment. We see this really clearly in the breakdown of dealer pressure points. It highlights the intense disconnect between the overpriced, overfeatured cars the OEMs insist on building and the vehicles that local markets can actually absorb without the dealer taking massive floor plan losses.
Exactly. And the third theme is regulatory pressure. Supported by the survey of dealer leaders warning of a profit squeeze, we see the FTC's shadow looming over dealership advertising and the entire structure of finance desk disclosures.
But within those themes, there are massive unresolved contradictions.
Oh, absolutely.
Take the stair-step incentives. The CDG Circles survey in the Profit Squeeze report shows near-universal hatred for these programs among dealers. But the operational analysis of dealer leaders sounding the alarm reveals a stark contradiction in how to actually handle it.
Right.
Do dealers band together to demand systemic reform of the bonus structures? Or do they simply vote with their capital and avoid those brands entirely?
There is also an ideological tension regarding the direct-to-consumer model versus franchise accountability. You have the argument presented in the dealer pressure points breakdown, where dealers insist that the franchise model inherently protects consumers through local competition. But that is placed directly against the ongoing OEM push, noted in the profit squeeze warnings, to bypass dealers entirely in order to recapture lost margins and control the customer experience.
So what does this actually mean for you, the listener, who eventually has to navigate this incredibly stressed market?
Yeah, what's the bottom line here?
The practical takeaway distilled from all of this friction is stark. Dealers and automakers must standardize their compliance to satisfy the FTC, unify their fragmented and adversarial customer surveys, and relentlessly strip unnecessary, expensive content from their vehicles.
They have to get back to basics.
Exactly. Because if they do not quickly align the physical product with the buyer's actual mathematical budget, this bifurcated market will permanently break the mainline dealership model.
The dam has broken upstream, the hidden kitchen fees are on the receipt, and the pressure is entirely on the showroom floor. Thank you for joining us for this segment of Auto News Talk. And remember, the consumer will ultimately be the final judge. You will vote with your wallet on whether 84-month loans, direct sales without local dealers, and heavily screen-laden cars are the true future of transportation, or just a massive industry-wide miscalculation.
So keep an eye on the entry-level lots in your town. As a pre-tariff inventory finally depletes, watch closely to see if those stripped-down affordable commuter models disappear entirely. Thanks for listening to Auto News Talk, and we will see you next time.